25% core profit growth made the headlines, but the yield, gearing, and interest coverage numbers did not. I have been tracking Keppel's transition since the asset management pivot began, and this is the first quarter where the yield math itself, not just the transformation story, forces a hard stop. Two very different investors are reading this stock right now, and the numbers we are about to unpack matter differently to each of them. Let us look at what actually happened in the first half of 2026. As this is going to be a very comprehensive deep dive, please be prepared for a longer video as I have done quite a fair bit of research. The headline figure shows core profit up 25%. The reality is that consolidated net profit dropped 59% into a sea of legacy red ink. Management wants you to focus on the new operating engine, but your cash returns still carry the burden of yesterday's offshore rigs. Revenue is up 24.5%, yet that growth is completely overshadowed by the massive drag from the non-core portfolio for divestment. If you are relying on Keppel to fund CPF or SRS drawdown next quarter, the yield math forces a hard stop. If you are a growth investor watching the transformation story, you might view the numbers through a different lens. However, the Zone 5 verdict here means you need to stop before averaging down on today's dip. The data points we are extracting from the balance sheet are structural, and they demand immediate attention before you deploy any more capital. Keppel presented its first half results under a dual lens framework, isolating the new Keppel core operations from its legacy assets. The core asset management and operating engine generated 530 million Singapore dollars in net profit, which is a 25% increase year-on-year. However, the non-core legacy assets dragged the total group down with a severe $375 million net loss, severely impacting the consolidated bottom line. Looking at the consolidated group scorecard, revenue expanded 24.5% to 3.8 billion Singapore dollars. Yet total net profit plummeted 59% to $155 million. That massive 500% loss expansion in the non-core segment is what anchored the consolidated results. The divergence between the growing core and the bleeding legacy assets is the central tension of this earnings report. The infrastructure division remained Keppel's central profit driver. The segment delivered $538 million in net profit, representing a 55.5% expansion year-on-year. Consolidated division revenue hit $2.5 billion, up 26.8%. Segment operating profit grew strongly, while EBITDA surged nearly 49% to $631 million, proving the operational engine is firing as intended. The core operating engine within integrated power generated $356 million in EBITDA, up 9% year-on-year. Growth was bolstered by the commercialization of the Keppel Sakra Cogen plant in late May 2026. This plant expanded total operational power generation capacity by 45% to 1,900 megawatts. The single month of operational contribution helped offset softer regional spark spreads and elevated fuel logistics costs caused by Middle Eastern instability. Management's power contracting mix actually shifted towards shorter tenors over the past 6 months, not longer ones. Contracts under 1 year rose to 8% of the power portfolio. The 1 to 3 year band saw the largest single shift in the book, expanding to 49% from 28%. The contracted book skewed shorter in the first half of 2026, cutting directly against the narrative of locking in long-term baseload cash flows. In decarbonization and sustainable solutions, long-term contracts expanded to a cumulative order book of $8 billion, up 2.4 times since 2022. That provides an active trailing 12-month book-to-bill ratio of 3.7 times. The Hong Kong Integrated Waste Management Facility reached 98% construction completion, with its 15-year contract starting this year. Meanwhile, the Tuas Nexus facility in Singapore is entering testing and commissioning. The connectivity division expanded net profit by 54% year-on-year to $77 million, driven by subsea cable deliveries and technology solutions contracts. Growth was anchored by the full commercialization of all 5 fiber pairs on the Bifrost cable system, securing $1.3 billion in indefeasible rights of use and operations contracts. The project generated an internal rate of return of approximately 30% for Keppel and its co-investors. Keppel's global data center platform encompasses 37 data centers across Asia Pacific and Europe, with a total gross power capacity of 840 megawatts, 60% of which is currently operational. Keppel Technology Solutions secured $400 million in new contracts during the first half, building a 5-year delivery pipeline of $1.9 billion. They are also actively engaging prospective hyperscale clients for the 720-megawatt Melbourne Powerbank site. One is executing a 3-year cost reset targeting $70 million in annual run rate savings by 2028. The company achieved $4 million in run rate savings year to date in 2026 against its $10 million full-year interim target. Management continues to explore regional industry consolidation opportunities while maintaining the core operational resilience of the telco business. The real estate division swung to a net loss of $19 million compared to a net profit of $98 million in the same period last year. Operating profit dropped into negative territory, and EBITDA contracted 82.9% to $29 million. This loss was primarily driven by a non-cash accounting loss of $51 million associated with the dividend-in-specie distribution of Keppel REIT units to shareholders. Keppel announced $473 million in real estate asset monetizations year to date in 2020. The active residential land bank totals 31,811 units globally. However, risk is highly concentrated geographically, with 75% of those units located in China and Vietnam. The asset-light strategy is progressing, but the legacy land bank still needs significant capital management to work through. Management spent substantial presentation time celebrating $106 billion in funds under management and the Sakra Cogen launch. However, they glossed over the massive $375 million non-core net loss. This legacy overhang is not a distant bad memory. It is a live $13.7 billion drag that consumed group earnings through rig write-downs and credit provisions. Silence on legacy drag is exactly where retail yield risk hides. The non-core portfolio for divestment carries a staggering $13.7 billion value as of June 2026. Property assets comprise 53% of that portfolio, while legacy offshore and marine assets account for 31%. That combined drag generated a net loss of $375 million, which represents a loss expansion of over 500% compared to the prior year. The non-core portfolio for divestment carries a staggering $13.7 billion value as of June 2026. Property assets comprise 53% of that portfolio, while legacy offshore and marine assets account for 31%. That combined drag generated a net loss of $375 million, which represents a loss expansion of over 500% compared to the prior year. Cumulative asset monetizations reached $14.9 billion since October 2020. Year-to-date 2026 announcements reach $1.7 billion, which includes $1.22 billion from monetizing 6 operational rigs. Keppel expects to collect $611 million in net cash proceeds from the rig divestments in the second half of this year, which is a critical cash flow metric we will be tracking closely. Valuation models show a clear divergence between core operational growth and consolidated balance sheet leverage. The new Keppel core return on equity came in at 15%, which is a genuine, already realized trailing result. But look at the consolidated group return on equity, which fell to 3.6%. That is a forensic gap of 11.4 percentage points, highlighting the heavy weight of non-cash write-downs and legacy debt on the actual entity you own. Think of this like buying a commercial shop lot that generates strong monthly rent, but finding out the owner tied the property title to a failing logistics business next door. The rental engine works well, but the parent company's cash flow must continually clear historical debts before equity holders receive their full return. The core operations are thriving, but the consolidated reporting entity bears the full weight of the legacy baggage. Here is the number that matters most if you are holding Keppel for income. At the $11.49 post-results close, Keppel's trailing ordinary dividend of 34 cents works out to a 2.96% yield. That fails my 4.7% minimum yield hurdle for retirement portfolios, and it outright fails the conservative 3.2% forensic floor I hold every SGX income name to. Even counting everything Keppel paid out this year, including the 2-cent cash special and the Keppel REIT units distributed in specie, total yield only reaches 4.09%. That still misses the 4.7% hurdle. Per standing policy, the in-specie distribution is excluded from the number that actually governs this zone call anyway, as it is a one-off asset recycling payout, not a confirmed ongoing program. The forensic floor and hurdle rates are anchored against the CPF Special Accounts guaranteed 4%, the highest quality guaranteed SGD yield that exists in the system. Even measured against a softer 6-month T-bill sitting near 1.50%, Keppel's ordinary yield barely clears that bar by less than double. For a business carrying real legacy leverage risk on its consolidated books, that is not the risk premium an equity holding should be paying you. Looking at the first part of the financial health checklist, core operating performance confirms solid recurring revenue expansion. Consolidated revenue is up 24.5% and core net profit is up 25%, passing the growth threshold. However, consolidated net profit fell 59% and the ordinary yield sits at 2.96%, failing the forensic floor required to justify the equity risk. The second part of the checklist confirms where the leverage breaks. Consolidated net debt to EBITDA expanded to 6.7 times, failing the 5 times threshold. Standard gearing hit 43.4%, breaching the 35% ceiling. Interest coverage fails on every basis tested, with operating profit alone failing to cover gross interest expense this half, yielding a 0.91 times ratio. Any one of these failures alone would be enough for a red zone call. The yield of 2.96% is below the floor. The standard gearing of 43.4% breaches the ceiling. The interest coverage ratio of 0.91 times shows operating profit did not cover interest expense. Having all three together verified from primary filings confirms a compound structural failure. 3 soft flags are also confirmed from the primary filings and data screens. The stock trades 12.3% above fair value, triggering an overvaluation flag. Net gearing has trended upward for 2 consecutive periods, showing rising debt pressure. Additionally, 92.4% of revenue came from Singapore alone, pushing market concentration well past the 70% risk trigger. The trailing ordinary total governing this zone call is 34 cents per share. The interim dividend remained flat year-on-year at 15 cents. While the total distribution including specials reached approximately 47 cents, engineered yield policies dictate we exclude those one-off payouts to assess true sustainable income. Income investors cannot rely on asset recycling distributions to fund consistent retirement drawdowns. At $11.49, the shares trade at a premium to the investing pro fair value of $10.23. That premium counts as a minor soft flag, compounding the core issue. The trailing ordinary yield of 2.96% simply cannot clear the baseline forensic flaw, meaning you are paying a premium for a yield that fails the fundamental income test. In this market, the difference between a sanctuary and a yield trap is decided in a single trading session. By the time this analysis reaches free subscribers, the entry window has already opened and often closed. Waiting for delayed data is how retail investors become exit liquidity for institutions. If you want the numbers when they still matter, not after the market has priced them in, Iggy's Elite Investors gives you 0-day access to these forensic breakdowns. You get the full red zone watchlist and institutional-grade cheat sheets the exact moment the setup is live. For 12 Singapore dollars a month, stop being the exit liquidity and start being the analyst. Looking at the scenario stress test, the base case assumes $611 million in RIG proceeds collected in the second half, maintaining dividends at 34 to 36 cents. The bear case involves delayed receipts and further real estate impairments in China and Vietnam, stalling the dividend at 30 cents. The bull case requires accelerated non-core monetization exceeding $3 billion to drive net debt below 4 times EBITDA. Management earned credibility by hitting their $100 billion funds under management target and achieving over $100 million in cost savings ahead of schedule. However, the planned $1.28 billion sale of M1 was terminated, forcing it back into the non-core portfolio. Non-core liquidation timelines carry real execution risk, and the market knows it. Management earned operational credibility by surpassing the funds under management target early, but credibility on portfolio restructuring requires equal scrutiny. The terminated M1 divestment forced a $32 million accounting reversal. When management commits to liquidating a $13.7 billion non-core portfolio by 2030, income investors must separate operational progress from deal completion timelines. Trust the collected cash, not the preliminary headline. This brings us to a Zone 5 red zone verdict. The portfolio role here is to avoid accumulation, unsuitable for transition or drawdown portfolios, especially anyone relying on CPF or SRS income. This is a structural verdict based on hard balance sheet data, not a short-term timing call on the share price. Each gate fails independently based on Keppel's own consolidated financial statements filed on the 30th of July. The low yield, high gearing, and weak interest coverage create a scenario of high financial stress and low stability. Any one of these metrics failing alone would be enough for a red zone call, but all three failing together confirm the compound structural failure. The new Keppel core engine transformation is genuinely real, boasting a 15% return on equity and 25% core profit growth. But those core figures are not independently verifiable from a standalone core-only balance sheet. The gearing and interest coverage figures are computed from the full audited consolidated balance sheet, which is the entity whose equity you actually own. Does Keppel pay enough to compensate for equity risk over a guaranteed CPF special account rate while carrying a balance sheet missing 2 independent leverage gates? Right now, it does not. A compound structural failure is not softened by how well the growth story elsewhere happens to be doing. 3 independent hard gates failing puts this firmly on the radar for the next earnings cycle. To recap the critical pressure points, operating profit did not cover interest expense this half. leaving coverage at 0.91 times. Consolidated net debt to EBITDA climbed to 6.7 times, and standard gearing breached the ceiling at 43.4%. Almost $2 billion in debt comes due within the next 12 months, requiring careful refinancing execution. For the next earnings cycle, watch whether the $611 million in rig proceeds is actually collected in cash. Track the real non-core monetization pace against the $2 to $3 billion target, comparing actual completions versus announcements. Most importantly, monitor whether the consolidated interest coverage recovery can clear the minimum 4 times floor. The transformation story at Keppel is real, and the core operating engine continues to deliver impressive growth. But as a retail investor, you own the consolidated entity, and that is the balance sheet this framework tests to protect your retirement income. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. When multiple leverage gates fail simultaneously on a consolidated balance sheet, waiting for the 7-day embargo window to lift leaves you exposed to market pricing. Join Iggy's elite investors through the link in the description to get these numbers when they still matter. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MES licensed financial advisor before committing funds.